Have you ever wondered if there is a faster track to financial success than the S&P 500? What if you could not only grow your wealth consistently, but also accelerate its growth over the next few decades? It's time to rethink your investment game and potentially transform your financial future. Over the years, the S&P 500 has proven to be the popular investment due to a century's worth of reliable historical data. But there is a strong substitute plan in the works that might surpass this tried-and-true approach. If $200 is invested each month for the following 40 years in a certain fund, the investment account might potentially grow to worth over $1 million. This means that a $96,000 original investment will rise to exceed $966,000 in compound interest. Although the S&P 500 is known for having strong long-term investment potential, the suggested substitute consists of two exchange-traded funds, with comparable or even higher predicted rates of appreciation. The strategy's main benefit is that it can help minimize the negative effects of market lows while simultaneously taking advantage of market highs. With this dual ETF strategy, you can potentially outperform the S&P 500 and get the best of both worlds. Observing this graph, the S&P 500 is represented by the blue line, while the other two ETFs are represented by the other colors. You can see that yellow has decreased significantly relative to blue during the last year. However, yellow is significantly greater than blue when we consider the last 10 years. This graph illustrates what an investment of $10,000 into each of these exchange-traded funds ETF would have grown to 10 years ago. Naturally, the blue graph in the middle is the best one to look at. It indicates that the S&P 500 has increased significantly. However, don't we sort of want to benefit from that yellow one? Here's how we want to mitigate it, while also keeping us safe, as anything that can travel very far up can also descend very low. I will give a brief explanation of each of these two ETFs, but understanding how to use them is much more crucial than understanding what they are and how they work. So stay tuned for that till the very end. Okay, so VOO is an ETF that invests in Vanguard funds. The next two ETFs I will select are categories, so feel free to select any kind of ETF that you will think will work well in this area. To compare apples to apples though, I'm going to limit them to Vanguard funds alone. Because dividend investments are inheritably stable, they fall under the first category. One notable fund in the dividend space is the Charles Schwab offering SCHD. The Vanguard High Dividend Yield ETF is unique within the Vanguard portfolio. It seeks to replace the investment performance of the FTSE High Dividend Yield Index, which pays out dividends on a quarterly basis and has dividend yield of more than 3%. VYM has demonstrated a remarkable average annual appreciation of around 10% over the last 10 years. This ETF's steadiness can be attributed to its heavy weighting of financial and healthcare companies. Strong businesses including Johnson & Johnson, JP Morgan, Procter & Gamble, and Home Depot are among the top 10 companies in the fund. The expense ratio is one of the most important factors to consider when examining an ETF, and at 0.06%, this one has one of the lowest conceivable. As an aside, now is a great opportunity to consider purchasing this ETF, as it is currently extremely cheap and in the super value category. Why a high dividend ETF is essential right now? You should use this dividend style category as one of your primary ETFs for two key reasons. The first is to maintain minimal volatility. It won't be the one that soars to great highs, but it also won't plummet to great depths when things go rough. Thus, maintaining consistency is essential. The cash flow alone comes next. You are eligible to begin receiving dividend checks as a passive income once you've worked on this for a few years. You have the option to do nothing except sit back and wait to get these checks every quarter for the rest of your life. The growth category of ETFs is the next and the most entertaining one. On the other hand, there is an increasing trend towards the Vanguard Growth ETF. This exchange-traded fund seeks to replicate the performance of the CRSP US Large Cap Growth Index, capturing the allure of growth ETFs with its thrilling possibilities. Interestingly, they have the potential to increase significantly, even though they are intrinsically riskier. In the last 10 years, VUG has shown gratitude. This portfolio portfolio, which consists of 250 stocks, has a strong emphasis of quickly developing sectors like consumer discretionary and technology. The majority of the fund's holdings, which includes titans of the industry including Apple, Microsoft, Amazon, Tesla and Nvidia, meet expectations. One of its primary characteristics, similar to the previous fund, is its low expense ratio of 0.04%. That is just really low for a growth fund. For instance, QQQ is 5 times more expensive than VUG with an expense ratio of 0.20%. Then ARK, one of the most well-known ones available today, has an expense ratio of 0.75%, making it over 20 times more costly than VUG. These costs mount up and deduct from your earnings. Thus, if a buddy advises you to go to invest in the CTF, please make sure that the expense ratio is among your first considerations. Like, if you were to combine these two ETFs with just VOO, you could invest in that one ETF forever and, in 30 or 40 years, have a tidy little nest egg. However, if you limit your investments to only one, you may miss out on the opportunity to earn passive income whenever you want, as well as potentially insane growth potential. Therefore, you might want to reconsider this method if you would want to see the results of all this investment work in 10 or 20 years rather than 40 years, and you want to start enjoying some of the rewards now. In 20 years, you would have $274,920 if you invested $100 a week into VOO, the S&P 500 index fund, which yields an annual return of almost 10%. That's nearly $300,000, which is a good amount. For $100 a week or $400 a month, not bad. Consequently, if we have $400 a month to invest, we will allocate $200 to the VYM dividend fund and another $200 to the VUG growth fund. Thus, you would have $137,460 if you had invested that $200 a month into VYM for 20 years. And in 20 years, you would have $183,265 if you invested the remaining half in VUG at a rate of 12.5%. There is now $45,000 more in total than if you had only invested in VOO. And keep in mind, nothing changed. Either $400 was invested in VOO every month, or $400 was divided up into $200 investments in each ETF. If you found any value so far, please like and subscribe. But there is still more. At this time, you can begin to take a dividend that is significant enough to be put to use in addition to the additional $45,000. And that's only 20 years from now, as opposed to waiting till retirement. At this time, VYM would generate a $4,200 annual dividend. One possible course of action would be to continue investing all of the money into the fund and allow it to grow significantly. After 5, 10, or 20 years, you could then completely rely on the passive income. Alternatively, you could merely receive a monthly payment of $350 for the rest of your life for doing absolutely nothing. Then there's the growth fund cooking, and you may have $2,115,820 after 40 years with just $200 in VUG. I understand that most of you are thinking, yeah, but that's not for 40 years. That is far too much time to wait. Well, perfectly fine. And there is a method to get it faster, and I will tell you the secret right now. These 3 ETFs are all winners, and even if you invest just $10 a month, you are already much ahead of most of your friends and the general public. That is all for this video. We will be back soon with another informative video. If you found any value, don't forget to like and share this video. Until the next time.